Welcome to The Explainer. Today, we are unpacking a massive, kind of mind-bending contradiction that's currently unfolding in the Chinese precious metals market. It's a story that's largely flying under the radar right now, but it contains absolutely vital clues about where gold and silver are genuinely headed. So let's just break it all down.
Okay, let's dive right into this paradox by just looking at the surface of the data. We are seeing a complete, total divergence in behavior. On one side, everyday retail investors and wholesale buyers are basically fleeing gold products, which is driving demand down to multi-year lows. But then, you look at the other side. The People's Bank of China, the PBOC, their central bank, is buying gold at an absolutely unprecedented, historic pace. So what does this all mean? How can both of these things be true at the exact same time?
Section 1. Deconstructing the drop and the rational retreat of retail.
We're going to start with a pretty striking number. 8.3 tons. That represents the exact drop in Chinese gold ETF holdings, the funds that let everyday people invest in gold, recorded in May of 2026. And this isn't just a minor blip either. This single-month decline literally ended an incredibly strong 8-month streak of consecutive inflows into gold ETFs. It's a huge event, but we really need to ask why it's happening right now.
Well, when we look at the drivers behind these outflows, a very clear picture emerges, and it's not a mystery at all. During this period, local equity markets were actually performing very well. So investors simply executed a capital rotation. They cashed out their gold to chase those immediate returns in the stock market. With gold prices staying relatively flat, short-term momentum investors just move their money to where the action was. They aren't mysteriously rejecting gold, they're just acting rationally based on relative opportunity cost.
Now, if we shift over to the wholesale picture, the ETF data was bad, sure, but physical withdrawals from the Shanghai Gold Exchange absolutely plummeted to just 64 tons. We're talking about a massive 38% drop in a single month.
To give you a sense of the sheer historical weight of that 64-ton figure, you would literally have to go back 16 years to find a May with lower gold withdrawal volumes. It was the weakest May for Chinese wholesale demand since 2010. This is a historically significant reading that absolutely demands an explanation.
So what is actually driving this immense wholesale weakness? Aside from falling gold prices temporarily pausing safe haven demand and those hot equity markets pulling capital away like we talked about, we have to look really closely at the jewelry sector. It's a massive component of Chinese gold demand, and right now we are seeing major affordability issues. Even with some recent price corrections, gold is still dramatically higher than historical norms, and it's shocking the everyday jewelry consumer. On top of that whole shebang, regulatory changes have introduced new tax burdens, creating extra friction in transactions. Consequently, major jewelers are incredibly cautious about restocking their inventories. They're remaining firmly on the sidelines.
Section 2. The Central Bank Buying Spree. Institutional accumulation.
So while retail demand plummeted and jewelers basically sat on their hands, the central bank was quietly and honestly ruthlessly executing its 19th consecutive monthly gold reserve increase. Just think about that for a second. 19 months in a row without a single interruption, totally regardless of price fluctuations or equity market rallies.
And just to brilliantly illustrate their level of conviction here, they didn't just add a token amount. They added 10 tons of gold to their reserves in May alone. That makes it their largest single-month purchase since December 2024. Over this phenomenal 19-month streak, the central bank has accumulated a staggering 67 tons of gold.
But here is the really crucial point. The People's Bank of China now holds 8.9% of its foreign exchange reserves in gold. You guys, central banks do not day trade. This is not a short-term trade meant to catch a quick price bounce. This represents a deliberate, long-duration policy decision to hold non-dollar, non-sovereign assets. They are structurally changing the entire composition of their national reserves.
Furthermore, this institutional appetite is totally reflected in the raw import data. Net gold imports into China jumped to 157 tons in April, driven heavily by Shanghai's positive price premium over London, which basically just means gold sold for more in China. It became highly economically attractive to import metal from global markets. This proves that the institutional metal flow into the country is not just continuing, it is aggressively accelerating.
Section 3. Silver's persistent deficit and the parallel structural challenge.
Let's pivot to silver for a minute, because we're looking at a pretty dramatic timeline here that builds into an equally urgent narrative. Silver is officially on track for its 6th consecutive year of structural supply deficits.
Since 2021, mine supply and recycling have fundamentally failed to meet total demand. And why? Because of relentless industrial consumption. Sectors like solar energy, electric vehicles, semiconductors, and 5G infrastructure, technologies where, by the way, silver cannot be easily substituted, they are relentlessly draining finite above-ground silver inventories year after year.
Now layer this critical vulnerability on top of that deficit. China controls the vast majority of global silver refining capacity. This creates a severe strategic bottleneck. It means that even silver mined in entirely different parts of the world must essentially pass through Chinese processing infrastructure before it can ever reach the industrial buyers who desperately need it.
This is such a glaring issue that major asset managers are literally sounding the alarm. As Tata Mutual Fund recently highlighted, relying on Chinese refining capacity for such a critical industrial input is a massive strategic vulnerability for nations worldwide. For countries like India, who are deeply invested in expanding solar and EV infrastructure, relying on a supply chain that could instantly face friction, sudden tariffs, or export controls poses a profound long-term threat.
Section 4, Surface versus Structural Realities in our Analytical Framework.
To really wrap our heads around this, we have to separate the market into two distinct lenses. First is the surface picture. If you only look at the surface, precious metals are currently in a correction. This near-term reality is heavily influenced by immediate macro forces, shifting inflation expectations, geopolitical volatility, and, as we saw, everyday investors rationally rotating their money into hot stock markets. It looks weak, and those near-term risks are highly visible. But then you have the structural picture. Contrast all that surface noise with this deeper reality. Massive, unbroken central bank buying by entities like the PBOC. 6 consecutive years of unyielding physical silver deficits driven by explosive industrial demand. These factors demonstrate an unshakable, long-term foundational strength that operates completely independently of whatever the stock market is doing this week.
You have to remember that neither perspective is inherently wrong, right? They are simply answering different questions based on time. The surface picture, all those retail outflows and price corrections, that dictates the trading reality for the next 2 weeks. But the structural picture, the institutional hoarding and persistent supply deficits, that dictates the positioning reality for the next 2 years and beyond.
So I want to leave you with this final provocative thought. Which time horizon are you actually operating on? Are you reacting to the noise of the next 2 weeks, or are you positioning for the structural realities of the next 2 years? Let us know your time zone down in the